Warren Buffett's Berkshire Hathaway has recorded 19.9% annualized returns since 1965, which trumped the S&P 500 gains from that same period. Now, you may be wondering, how did he achieve this? Well, Warren Buffett used a lot of the principles that I'm going to talk about today and a lot of the principles that are in this book. He read this book when he was very early on in his investing career. And this book is by Benjamin Graham, who is also known as the father of value investing. So he got so much value from this book that he was able to internalize those concepts and lead Berkshire Hathaway to get these amazing returns decade over decade over decade. So in this video, we're going to go through three major points that I took from this book and various other financial concepts and books. If you want to get The Intelligent Investor and read it yourself, I've linked it down in the pinned comment below, and so you can grab a copy whenever it's convenient for you. But with that, let's get into this video and understand these three concepts. The first point I want to talk about is the difference between value investing and something like technical analysis. So value investing is for the fundamentals of the company, whereas technical analysis just looks at the price action, ignoring all the fundamentals, the news, everything else. And they're looking at the end result, which is basically the price action. But I want you to keep in mind that price action is an outcome of the company's value in the long term. So this is the same as saying in the short term, it's a voting machine. The stock market is a voting machine. And in the long term, it's a weighing machine. So the company fundamentals are the weight. So in the long run, the weight of the company, the fundamentals of the company will always win out over just short-term price action. Now, I'm not saying that technical analysis doesn't have its caveats and reasons for existing. It's very often useful for finding entry points, for looking at support and resistance levels, for looking at channels and patterns and waves. But overall, it is a reactive thing to the price action, which comes after the value and the fundamentals and the news for the company has already been achieved. Investors, value investors especially, are looking at things like, what is the ROIC of a company? What is the CAGR rate over the past 5 years? What is the trend of the revenues? What is the trend of the profit margins? So what direction is the net income going? How much did they spend in CapEx? Are they doing any share buybacks? Are they doing any dividends? And many more things. And these are the things that value investors are looking for to evaluate a company relative to their peers in their industry or by itself intrinsically. Oftentimes, it's best to have a basis, a foundation in value investing, and then use technical analysis from time to time to see what's a good entry point if you're trying to get into the market or trying to get into a specific position, and just to avoid certain pitfalls in like the short term or like in a snapshot of this whole stock market and your whole history in investing. So it's a tool that value investors can use, but there's a stark difference. It's two different schools of thought for both of these. Now, this leads into the second point that I want to make. And the second point is talking about relative versus intrinsic valuation. And I got a question about this recently from one of my subscribers on a video I did in the past. And I wanted to talk a little bit about this and really elucidate what the meanings behind these are and give examples. So let's start with relative valuation. So relative valuation for a company is things like the PE ratio, the PEG ratio, the PEGI ratio, the PS, the PB ratio, price to earnings, price to sales, price to book, EV to EBITDA. All these ratios are necessary to relatively value a company versus their peers. You can sometimes look at these metrics by themselves because you can, after a while, you get to know like all of these different metrics and see the ranges which a PE value should be in a certain industry. For example, semiconductors, PEs could be very high because there is a lot of action, a lot of volatility, and a lot of growth in that industry. But for other industries, maybe cyclicals and like industrials or utilities, the PEs could be lower. And if you see a high PE in a relatively low PE industry, that could indicate overvaluation, because PE is just price to earnings and price over earnings. So if it's a very high PE, that's potentially saying that the price is elevated over the amount of earnings that company makes. So it can be due to a lot of factors. It doesn't necessarily mean that. It could also mean there's a deceleration in earnings. It could also mean that the price is going up and the earnings haven't caught up yet. So there's very many ways to look at things relatively. And this is in contrast to intrinsic value. So intrinsic value is just like the namesake. It is what the company is worth at the current time that you are evaluating this company. So there is a school of thought, and it's described in The Intelligent Investor. And in value investing, it's a common thing, but the value of a company, the intrinsic value of a company, is the sum of all the future cash flows that company is going to produce, discounted to the present time. So another way to say that is, this is the discounted cash flow analysis of a company. And in that way, you can get the true value of a company and what it's worth today. Now, there are a lot of caveats with this DCF analysis. It depends on company type. So high growth companies can be evaluated with a DCF model. But if you're looking at a REIT, real estate investment trust, or a financial, you may have to use an AFO model, which is adjusted flows from operations. And if you have a company that pays a large portion of their shareholder returns in the form of dividends, you may have to use a dividend discount model. But I want you to keep in mind that there is a difference between relative valuation and intrinsic valuation. And good investors, good value investors, look at both. And then they use that plus the 10Qs, 10Ks, plus what the management is saying, plus what the management is guiding for in the future year. There's so many pieces and various factors that go into value investing. But I want you to keep in mind, in order to become a great investor like Warren Buffett, you need to master all of these things. And in this channel, in this Bearded Investor channel, I want to help you master those things. So this brings me into my third point, and this is another question I received from a subscriber. And he noted that I don't have ETFs in my public account. I only have individual stocks, and this is by design. So individual stocks have a leg up over ETFs. ETFs are great for diversification, but they lack the ability to return gains like individual stocks. If you pick high quality, high compounding machines, individual stocks like Meta or Google or Amazon, these stocks will outperform any ETF that you can name. And the reason for this is multifold. A few of those reasons are they do share buybacks, and I will have a separate video on share buybacks because that is a huge topic onto itself. There's different forms of shareholder returns in individual stocks. The stocks can appreciate much faster with good earnings. Earnings matter much more. If you have an individual stock that reports great earnings, they can jump and leap and increase their multiple analyst expectations very, very, very quickly. When in ETFs, you have maybe 10, 20, 50, 100 stocks. And if one of those reports great earnings, it's not going to move the needle that much. And so my whole investing thesis and philosophy is concentrate your high growth, high quality, high compounding stocks and make real returns, not just, oh, let me make $1,000 here, $10,000 here. I want to make hundreds of thousands of dollars, millions of dollars on these positions. So that's why I chose to do this in my public account. Now, there is a time and place for ETFs. And if you do not feel comfortable picking out individual stocks, or you haven't got the knowledge yet and watched my videos and gotten this knowledge yet, then by all means, get into ETFs, high quality ETFs, and stay there until you are able to pick individual stocks and feel confident in doing that. Like I said, there is a time and place for ETFs. And in my retirement accounts and my HSA and all my other maybe tax advantage accounts, you could say, I have ETFs. And that is just to protect those things. It's a more of a defensive position to be in an ETF rather than a stock, individual stock, because you are betting on the diversification to protect you from a large downturn in the market. Large, geopolitical war happens, or tariff drama that you're anticipating. I choose to be more aggressive with my investments in my public account to get those gains that I know is possible in investing in high quality and high compounding stocks. And that's it, guys. Those are the 3 points I wanted to elucidate and clear up for you guys. And hopefully I did a good job. Please let me know in the comments below if I did or did not. And let me know if you like this content and want me to continue doing content like this. I will always continue to do individual stock analysis and relative and intrinsic valuations for those stocks, because I'm always trying to find the best possible investments or additional investments for the public account. And I do want to grow that public account so I can have more individual stocks. The pinned comment below will have the link to the Intelligent Investor if you want to pick that up. I highly recommend value investors read that book, just cover to cover, because it has so much information, and super investors like Warren Buffett have sworn by this book to help them with their returns. So I highly recommend that book. And if you like this content, please like and subscribe, and I'll see you guys in the next one.